Marco Annunziata with us from General Electric Corporation. Dr. Annunziata, good to see you again.
Good to see you, thanks.
Let's look at the Italian yield. Bring up the number right away, if you would, Rex. And you could see here the good news for Italy. And we bring up the number, and there it is, 3.54%. That is the Italian two-year yield, far better than Friday, 4.516%. Is 850 billion euros, well over $1 trillion. Marco, is that enough for Italy and Spain?
I think what's enough for Italy and Spain at this stage is the commitment of the European Central Bank. That is really the game changer. The ECB has unlimited firepower from a technical perspective. They can buy as much as they want. There will be political constraints, but for the moment, the fact that the ECB has stepped in supporting both Italian debt and Spanish debt is huge. So this really is the game changer for both Italy and Spain. It has to be supplemented by continued policy efforts by both Spain and Italy on fiscal policy, structural policy, to alleviate the political burden on the ECB, because this was not an easy step for the ECB to take.
How will the people of Germany, of the Netherlands, of France, how will the public respond to this rash act by the ECB?
Well, let's not call it a rash act, Tom. The ECB had to do this. It was the only way to really stop contagion in its tracks at this stage. But as I say, it's a difficult choice because it means printing money and buying the debt of governments with dubious records of fiscal responsibility. So especially in Germany, I think you will see more and more of the population getting concerned, wondering whether this is the ECB financing fiscal deficits and whether this might eventually open the way to inflation pressures. So, unfortunately, that is becoming the weak point of the European rescue program, the difficulty in really whipping up sufficient popular support for the difficult measures to take. And Germany, as you pointed out, is now the key.
Marco, we're going to introduce a chart right now, folks. It needs some explanation. This is the single best chart I've seen on the trouble that America's in. I need to explain this, and it may take 2 hours. This is from the IMF and from Carlo Cottarelli. It is what's called a four-quadrant scatter dot chart. Stay with me here. You can see Greece in the upper left corner. They have austerity and rising debt. And there's Spain. They have austerity and they have less rising debt. There's the United Kingdom on the edge of peripheral. Canada doing much better than bring it over, Victor. There's Italy and there's good Switzerland. And look at the dogs up in the right corner. Rising debt and deficit. There's Japan. We know how bad that is. And there is the United States of America alone with Japan. This is the single best chart I know. This is one of the reasons why S&P made the White House indignant. Dr. Annunziata, as we look at the work of Carlo Cottarelli and the people at the IMF, how grim is it for the United States? Do we need that austerity like Greece and Spain now, or like we're suggesting for Italy, or can we wait on austerity?
We definitely do not need fiscal austerity today in the US. Given the fragility of the economic outlook, of the growth outlook, it would be counterproductive. What we need today, though, is a strong commitment, concrete measures that will bring the fiscal deficit down in the following years, over the medium term. So we need today actions to reform entitlements, Social Security, Medicare, Medicaid. This really is the key. And this is what the markets, as well as the rating agencies, have been looking for. Actions today which do not contract the fiscal deficit and hurt the economy today, but give you guarantees in the future.
Rex, bring back that scatter dot chart. I want to show you what Dr. Annunziata just described. So what he's describing is the United States in the upper right corner with Japan. Should we go way over to the left side of the chart and be more austere? And you hear Marco and everyone else looking for less austerity now, but a medium-term and long-term solution. We'll bring that chart up a lot here in the coming days and weeks as well. Earlier this morning on Bloomberg Surveillance, I spoke with Mohamed El-Erian. I asked Dr. El-Erian what he thinks will come out of the S&P downgrade.
Our hope was that the S&P downgrade would be a wake-up call that would lead to what you've heard me refer to as the Sputnik moment, a realization that we need to do something different. The reality over the weekend is that we saw two disturbing developments. First, a very unfortunate and public clash between S&P and the U.S. Treasury. And second, a blame game in Washington as to who lost the AAA. So let's hope that we can get over this initial reaction because there's a lot at stake here.
Mohammed El-Arian this morning. Dr. Annunziata, you work for the General Electric Corporation. You briefed Jeff Immelt on industrial economics. What will be the reaction of corporate America, not GE, I understand that's not appropriate, but what will be the reaction of profitable big business in America to the events of the last week?
It's a reaction of concern, and concern on two counts. The first one is that the plummeting confidence we're seeing and the weakening in the data is undermining confidence in the near-term growth outlook. So this creates clearly some concerns for the corporate sector. But more importantly, I think the lack of progress on medium-term plans, on fiscal consolidation, which S&P has underscored, is one of the reasons why you see corporations being reluctant to invest today.
Dr. Annunziata, thank you so much. Marco Annunziata with the General Electric Company.